Hello traders, Gary Wagner here. The following is a special edition of the gold forecast for Tuesday, June 18th. Traders, it is good to be back, and after being off for a large part of last week, it allows me to look at this gold chart with fresh eyes. And what jumps out at me is, even though last week was filled with lots of fundamental events, the conclusion of this month's FOMC meeting, the latest inflationary data, we saw gold trade between $2,307 and $2,350. A price range of only $50 over an entire week, a range which we can easily see in a single day. So the question becomes, after seeing gold drop, trade sideways, drop, and trade sideways, whether or not gold will find support and form a double bottom or break below 2307 to yet a lower low. To answer that question, we will present a couple of studies to clarify what could unfold. The first study that we will present is the stochastic indicator or oscillator, which looks at closing price and compares it to the highest high or the lowest low over a period of time. The stochastic oscillator is a range-bound momentum indicator consisting of two lines that move between 0 and 100. The first line, known as the K line in orange, displays the current close in relationship to the highest highs or the lowest lows. We look for the lines to cross and move back either above the 20 or below the 80, giving us a indication that a pivot or key reversal could be imminent. As it pertains to our current scenario, we did see the stochastic oscillators cross below 20 and move back above it. That could be a signal that this recent low will prove to be the conclusion of our correction. If that's correct, we will see gold move back up past the 21-day exponential moving average and approach $2,380. Next, we want to add a simple Elliott wave count, and the wave count we want to look at assumes that we had our first wave 1 beginning in February, concluding in March, our corrective wave number 2, our third impulse wave here, a fourth, and then a conclusion to our impulse phase, our fifth wave. We then can postulate that we can be looking at a B, C correction because the lows came in just below the 38.2% fib retracement in acceptable correction to the impulse cycle that came before it. Lastly, I want to add our Heikin-Ashi and volume studies to the Elliott wave count along with the stochastics. The differential between a candlestick chart and a Heikin-Ashi is the open in a Heikin-Ashi is fixed from the midpoint of the prior candle. When trying to determine if a double bottom is in place, we can't be definitive from a Heikin-Ashi. However, what we can say with some confidence is the trend strength has diminished greatly. We've entered a period of alternating candle color as well as upper and lower wicks, which says that the recent correction or downtrend has lost a lot of vibrancy or strength. When we look at volume, that has been decreasing also. When we combine these two along with our other two studies, it does suggest the possibility of at least a short-term bottom in gold. Gold has been on a runaway tear in terms of moving to record highs throughout the last couple of months, and the fact that we had a very short correction would not surprise me given the recent strength in gold pricing. This has been Gary Wagner wishing you, as always, good trading. We will talk to you tomorrow for the next daily update and review. Bye-bye.